How much money do you really need to live off dividends? I've tried 1,000,001 passive income techniques, and they never really seem to be that passive. Even real estate isn't that passive once you own 3 or 4 properties, unless you pay a property manager. At that point, it's going to heavily eat into your margins. By far, the easiest passive income has to be dividend stocks. Since you just buy the stocks, you sit back, and you rake in the passive income. Don't need to do anything else. That being said, contrary to what the dividend influencers might tell you, dividend investing might return a lot less than you might think. But we'll talk more about that later. Another great passive income investment is subscribing, which might be even better because it's free. And then you can passively rake in all the financial education your attention span can handle. All right, thank you so much for watching. Let's get started. First, we need to talk about the basics. Whenever you buy a stock, you take partial ownership in that company, which then entitles you to a portion of their profits, which for many companies is distributed on a regular basis, like once a quarter, and this is called a dividend. This is set as a fixed percentage based on the price the stock is currently trading at. Suppose you have company X, and their stock is trading at $100, and their dividend is $5 per year. The yield would be 5%. Now, assuming the company didn't change their dividend, the yield would fluctuate up or down as the stock price moves, remaining around $5. It's generally thought that companies only pay a dividend when they can't get a better return from reinvesting the money into the company. This is typically why you tend to see dividends being paid from older or well-established companies, while young, quick-growing tech companies reinvest all their profits right back into the company instead of paying out a dividend to the shareholders. So don't expect to see a dividend from your Tesla stock anytime soon. If a company does in fact pay a dividend, the typical range is between 1% and 10%. The S&P 500 pays around 1.3% because it contains a mix of dividend-paying stocks, like value companies, and fast-growing tech companies that don't pay dividends. The dividend yield would definitely be the easiest passive income you could ever earn. It has to be the only investment that you can literally set and forget and get an income from it, without having to do any maintenance or work or upkeep on it at all. You can earn a reliable return over a period of time without having to sell any of your shares. And it gives you extra money that you can reinvest in more dividend stocks, or gold coins, or one of those overpriced JPEG things that the kids like these days. I don't know if they still like that. Many people will even just build up a dividend portfolio and live exclusively off dividends when they retire. Now, there are definitely some pros and cons you need to consider when dividend investing. Now, they're really fun investment because it feels like you're getting paid for absolutely nothing. They're also pretty well insulated from the market volatility. If you invest in growth or tech stocks, you've probably seen how large the fluctuations can be year by year or even day by day sometimes. With a dividend, you can reliably expect to receive the same payments whether the stock price is up or down 50%. Now, if you look at this chart based on data from multiple.com, you can see that dividends in the S&P 500 have only dropped more than 20% once since the Great Depression. If you compare that to the average annual return of the S&P 500 itself, which has seen 2 drawdowns of nearly 50% over the same time period. Overall, the dividend yields are much more stable, and for someone who needs a consistent cash flow, like a retiree, that goes a very long way. It also helps that the companies who offer dividends tend to be well established, and they prioritize stability. They've been around way longer than Casper mattresses or Palantir. Additionally, dividends have even been known to increase during recessions. Going back to the dividend chart, you can see that yields have increased in 3 of the last recessions, including a whopping 46% jump in the first recession after World War II. Although this doesn't happen every year, the average cut to dividends is around 0.5% compared to the average stock market decline of over 30%. Fourth, dividend stocks can provide a comparable return to the overall market. U.S. News claims that dividends alone account for over 40% of the total market returns over the past 90 years. They also point out that dividends have accounted for 54% of total market returns whenever inflation has averaged 5% or higher. So although these stocks don't go up as much in a bull market, they don't drop as much in a bear market either. Next, depending on your tax bracket, dividends may be taxed at a much lower rate than ordinary income. Qualified dividends don't require paying any taxes for single individuals making under $47,025, 15% on income for $47,026 to $518,000, and 20% for everything over that. For married households, you'll need to pay nothing if you make $94,000 or less, 15% on incomes between 47 and 291,000, and 20% on everything over that. Now this could really play to your advantage if you have a lower income, or when you retire if dividends are a large portion of your overall income. Now, there are certainly some drawbacks that we need to talk about. First is the fact that dividends are not guaranteed. Although companies will tend to try to pay dividends when they can, dividends come from profit. So if the company had a bad quarter or a bad year and doesn't make any profit, there isn't any money to pay out in the form of dividends. Next, and most importantly, dividends mean nothing if the stock itself just isn't doing well. That 5% dividend definitely won't make up for a 50% dip in the stock price. Now, this is a dramatic example, but it's not too far-fetched. AT&T, the telecom giant, has struggled with its stock down significantly, currently trading at levels not seen in decades. Over the past year, it's dropped 22.5%, although it still offers a high dividend yield. Realty Income, a real estate investment trust, has seen its stock drop 19% over the past year due to concerns about commercial real estate market. Clearway Energy, a renewable energy stock, has lost 34% of its value in the past 12 months, heavily impacted by the rising interest rates. And this is while the overall stock market has rallied to all-time highs. Now hopefully, in the long term, the stock prices will recover, while you sit back and passively earn some dividend income. But there's always a chance that this doesn't happen, and the stock continues to bleed out until it's gone, taking your initial capital with it. Third, dividends can have a tax disadvantage as well. Unlike normal capital gains where you don't have to pay until you sell your stock or other asset, with dividends, you have to pay taxes after you receive the dividends. So, depending on your tax bracket, you might take a big blow. Additionally, the corporations pay taxes on the income that they made, so dividends are kind of taxed twice considering it's taxed at the corporate level, so they're not super efficient. And fourth, many economists argue that dividends make no difference at all. For instance, if a company didn't pay out a 5% dividend, their stock would probably go up 5%, and if an investor needed the money, they could just sell some shares. Full disclosure, I'll tell you that I'm in the growth stock camp. The only dividends I receive are from ETFs that I invested in, like the VOO Vanguard S&P 500 ETF. But if you decide you really want that stability and convenience of regular monthly dividend payments, how much would you have to invest to be able to completely live off these payments? Well, it really comes down to how much money you need to live. Someone who lives in a 20,000 square foot mansion with a 38-foot yacht is going to need a lot more income to support their lifestyle than someone who lives in a van down by the river, which I think is probably half of millennials these days with the current house prices. According to Yahoo Finance, the average retiree spends $52,000 to $60,000 per year. So for this example, let's go with $60,000. Now, you don't want to go chasing stocks with the highest dividend yields, because these will not be the most consistent, and many will tend to bleed out over the long run. The gold standard for dividends is called the Dividend Aristocrats. This is a stock market index composed of companies in the S&P 500 that have increased their dividends in each of the past 25 consecutive years. These companies are well established, being at least 25 years old, so you won't see something like Tesla or Palantir even if they decided to start paying dividends. Now, the final requirement is that they're large cap stocks, with market caps of at least $13.1 billion. Many of these stocks tend to outperform the market during downturns. They've only had 2 real drawdowns in the past decade or so, once in 2020 and once in 2018. And this is most likely due to the fact that these companies tend to be more conservative with their spending. And they really focus on rewarding shareholders. They aren't just shoveling money into the fire as fast as they can, like many young tech companies or VC-backed companies. The current dividend aristocrats yield anywhere from 0.20 to a whopping 10.9%, with an average yield of 2.79%. There are several different ETFs that offer pretty good exposure to these stocks. The largest is probably the Vanguard Dividend Appreciation ETF, which is ticker VIG. Since this ETF is a Vanguard ETF, the fees tend to be on the lower side, so you aren't losing much of your profits trying to maintain an index yourself, which would be a ton of work, and you'd also lose out to the tax advantages that ETFs have to offer. For example, ETFs are allowed to swap stocks for similar stocks, like for like, without having to pay capital gains tax. This means that as the index changes, the ETF can rebalance without paying capital gains. That would be passed on to you. If you tried to do this yourself, every time you sold a stock to rebalance, you'd have to pay capital gains, and you'd have less money to rebuy the next stock. You could also look at similar ETFs like SDY or DVY or many other popular dividend ETFs. Suppose we decided to invest with SDY. The current dividend yield is 2.22% for this ETF. To figure out how much we need to invest to retire on this ETF, you take the amount of income you need, or $60,000 for this example, and divide it by 0.0222 for 2.22% yield, which will put you at around $2.7 million. This is the bare minimum, as you probably want some buffer in case yields drop in the future. So let's just say a cool $3 million. This is definitely a realistic number, assuming you invested $15,000 a year for 40 years into something like the S&P 500 with an average annual return of around 8% after inflation. Now that we know the numbers, the $3 million question, is it worth it? Well, let's compare this approach to the golden 4% rule. The 4% rule says that you can sell a maximum of 4% of your portfolio each year, almost indefinitely. And if you're able to sell less during downturns, this can help make it last even longer. Now, some argue that the 4% rule is now the 3.5% rule, but you can check out my latest video on whether the 4% rule is dead or not to learn more about that whole debate. Assuming you're able to accumulate the same $3 million in the S&P 500 or some similar investment, instead of switching to dividends, with the 4% rule, if you just sold 4% of the stock each year, you would have $120,000 per year in retirement income, which is double the dividend scenario. So is it worth it? In my opinion, no. But to each their own. Maybe it's worth it to someone who wants some peace of mind and stability. But with that, I thank you for watching. If you enjoyed this video, please give it a like, subscribe, and I promise it'll pay dividends. Thanks for watching. I'll see you next time.